In May 2026, Boeing stock gained $6.33 in a single session, closing at $237.36, with after-hours trading adding another $1.08. For a company that spent years as one of the most discussed turnaround stories in industrial history, those moves reflect something specific. The market is reassessing whether Boeing's recovery is real. Boeing's story is one of the most complex and consequential in global manufacturing. Its 737 MAX crisis, subsequent production quality issues, and the compounding effects of the COVID pandemic on aviation demand created a multi-year period of financial stress, reputational damage, and operational challenges that no other major manufacturer has faced at comparable scale. This video examines where Boeing actually stands in its recovery, what the genuine risks to that recovery remain, and how to think about the stock and CFDs around it as a trading and investment opportunity. Understanding Boeing's current position requires appreciating the depth of the challenge it has navigated. The 737 MAX grounding in 2019, following two fatal crashes that killed 346 people, grounded Boeing's most important aircraft for 20 months. The financial cost exceeded $20 billion in charges and settlements and lost orders. When the MAX returned to service in late 2020, Boeing faced a COVID-devastated aviation market. As travel recovered, new production quality problems emerged, including a door plug incident in January 2024 that triggered fresh regulatory scrutiny and imposed production rate limits on the 737 MAX. These compounding challenges have left Boeing with a large order backlog, representing significant future revenue, but production constraints that limit how quickly that revenue can be recognized. The company has burned through billions in cash and carries substantial debt accumulated during the crisis years. The core of Boeing's recovery thesis rests on several pillars. First, aviation demand has recovered strongly. Airlines globally are expanding capacity, and aircraft orders reflect confidence in continued passenger growth. Boeing's order book is full. Second, production rates are gradually recovering as the FAA's oversight regime stabilizes and manufacturing quality improves. Third, the defense and space business provides a more stable revenue base that has continued to generate cash even during the commercial aviation challenges. Programs including the KC-46 tanker and various classified defense contracts provide revenue visibility independent of commercial aviation cycles. The market's positive reaction in May 2026 likely reflects one or more of these recovery indicators improving. When Boeing reports production rate increases, quality improvements, or better than expected cash generation, the market responds because the base case for recovery depends entirely on these operational metrics delivering. Any honest analysis of Boeing must acknowledge the genuine risks that remain in the recovery story. Production quality is the most critical. A single significant quality failure on an in-service aircraft can trigger new regulatory action, production halts, and reputational damage that resets the recovery timeline. The FAA's enhanced oversight is ongoing, and the tolerance for further quality incidents is essentially zero. Competition from Airbus is a strategic risk because during Boeing's multi-year crisis, Airbus captured market share and deepened customer relationships that will not easily reverse. Some airlines that might previously have been loyal Boeing customers have developed Airbus fleets, and that creates switching cost advantages for Airbus in future orders. Financial leverage is the third risk. Boeing's balance sheet carries significant debt accumulated during the crisis. In a higher interest rate environment, debt service is a meaningful cost, and any revenue shortfall from production issues reduces the free cash flow available for debt reduction. Boeing as a CFD trade requires clear identification of the specific catalyst you are trading and the specific risk you are taking. Earnings catalysts are the most significant recurring events. Boeing reports quarterly results that include production rate data, backlog status, cash generation, and guidance. Any of these metrics coming in better than consensus expectations tends to drive the stock significantly higher. Any disappointment, particularly on cash generation or production rates, can produce sharp declines. The second set of catalysts is news-driven. Production incidents, significant new orders or order cancellations, and defense contracts awards. These are unpredictable in timing, but often material in price impact. For position sizing and risk management, Boeing's historical volatility suggests that stop losses need to be set with awareness of the stock's tendency to gap on news. Tight stops on Boeing often get triggered by normal news flow volatility. Wider stops require either smaller position sizes or acceptance of larger potential losses. Boeing's recovery is real, but remains incomplete. The operational improvements are measurable, the demand environment is supportive, and the long-term position of a duopoly manufacturer of large commercial aircraft is structurally strong. The risks are equally real. Production quality is a single-point failure. Airbus competition is strengthened, and the balance sheet requires sustained cash generation to deliver. For traders and investors, Boeing represents a genuine recovery opportunity with identifiable catalysts and a clear set of risks to monitor. The discipline is tracking the operational metrics that tell you whether the recovery is on track and having clear risk limits for scenarios where it is not. What is your view on Boeing's recovery? Please leave it in the comments below. I'll see you in the next video.